Okay, everyone, here we go. This presentation is provided solely as a courtesy to the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by forex.com. And this presentation has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange and other leveraged products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodity Exchange Act. Contracts for difference, or otherwise known as CFDs, are not available for US residents. So there we go with that one. Let me just get rid of this, guys. Pull up a chart, and off we go. Okay, so I'm not seeing any headlines crop up quite yet about Putin, but I'm sure they will at some time. This is just euro. It's just put things in a bit of perspective. That's what we've had a bit of an unsteady start to the day for sure. In the sense that we've been, or to the week, sorry, so that we've been up. Yesterday we're down today. There isn't any direction really that you can cling on to, right? Unless you're a very, very short-term trader. There hasn't been a theme to really live on. Pan, you're saying everyone's headed to the bunkers. Well, they might be after this press conference. We'll have to see. But obviously, everyone's headed to the bunkers. I wouldn't say yet. I would say there's a possibility. I would say that they are heading to the sidelines, and hence this kind of choppy, nasty bit of action that we've seen in euro dollar really over the last week. I believe he may not be, it may just be slightly delayed, but it could be any second. I'm not seeing a headline yet. Some of you may see them before me. But do share. And we'll try and navigate what this all means. But as you can see, this is the daily chart. Let's take a look at the hourly. Sentiment really coming off as we wait for Putin to speak, or as these are Pound's words, not mine. He's calling him a madman. We are coming off. We are backing away from those 139.50 highs that we reached earlier. But we are still very, very close, right, to those highs that really annoyed the ECB. They annoyed Draghi enough last week that he came down and said, no, I don't want this. So actually, in a strange way, we could see Putin do the ECB a favour by limiting upside there for the euro. So as you can see, it's more of a holding pattern. This isn't a trend. Like in the very, very short term, obviously a break below 138.75 is bad news. It could take us down all the way down to sub 138.50, and then potentially down to kind of this 137.24 level, which is the lowest level since the 6th of March. But we're still looking quite strong, even in a short-term range. So we just backed off the highs rather than kind of, give up altogether. One thing that is quite interesting, and I do want to draw your attention to, if you are looking at this from, if you are looking at the euro and you are a euro bull, is that it's interesting that we didn't get back to those kind of 139.67 highs that we saw on the 13th. Instead, we've kind of, it suggests that the market is taking heed of what Draghi is saying. I do not think it was a coincidence that he said something about the euro when we were just a breath below 140. 140 is a psychologically important level. For me, that's a soft line now in the sand. That's where the ECB doesn't really want it to go to. Now, they're not going to do anything other than kind of, hint that they think it's kind of useless. Hint that a strong currency is disappointing, or maybe a strong currency is annoying for them. 145 is, I think, when they could come in and do something, maybe threaten to take some action. If that's what they were choosing to do. So again, for me, 145 is probably the bigger risk for the bulls there. And just because Putin has said something doesn't necessarily mean, just because Draghi tries to talk down the euro doesn't necessarily mean that's the direction it's going to go in. But I do want to show you how important it can be when the market does listen to Draghi. because this is what happened the last time he talked down the currency, and that was he did it in a very, very clear-cut way. He said the euro is overvalued, it's above its value, this isn't on. We got to a high of we were lower than where we are today. We got to a high above 137. That coincided with the February 2013 this coincided with the February 2013 ECB meeting, and he slammed it, and we dropped we dropped kind of 900 points on the back of what he said. Got all the way down to 128. So when the ECB say something, they do mean business. And that was the low of the year, actually, one of the lows of the year. So again, because we're closer we're closer to 140 now, there's further to fall, I think, is what a lot of people are saying. So that's kind of the risk that a lot of people are worried about. I also want to look at dollar, because the dollar index has been under a lot of pressure. Last week we've started to see the economic data in the US just disappoint, really, and it's just getting harder to justify it on the weather effect. Of course, in 2 weeks' time, when we get that payroll data, that's going to be really important, because that's the March payroll. So one would hope that the weather effect won't even have an impact on that. So that's still, yes, we've still got a big test ahead. But if we just look at the dollar index here, as you can see, just looking so weak, it's looking very pathetic, really. We're getting close to that October 25th, the low, which came in at 78.98. That was the lowest level for quite some time. Let's have a look. Yeah, that was the lowest level, really, for the last 12 months. And we are just looking very weak within the range. Now, obviously, we're not nearly back down to those lows that we were at in 2011, when we got all the way down to 72.69. That was kind of in the, that was, even before QE infinity. But now that we're in tapering, it seems a bit odd that we are falling lower. And maybe the better risk reward is to actually look for a dollar rebound. Now, there's a couple of things that could cause a dollar rebound. Obviously, if the March payrolls are much better than expected, we maybe get some upward revisions. Maybe we see, so Putin is speaking now. He is saying the Soviet Union couldn't imagine Russia or the Ukraine as separated. So we are watching this very, very closely. I'll just show you what the immediate dollar reaction has been. Oh, not too much. We are pushing a bit higher. Sometimes that could be a bit safe haven. And again, that could be something as well that triggers that dollar rebound. It's just on the back of safe haven. Now, where we think the dollar could do well, if the risk environment stays steady, right, and that's a big if, is possibly with the Swiss franc. The Swiss franc is looking very, very, this is dollar Swiss franc, it's looking very oversold. In our view, let me pull up the other chart as well, so I can show you how oversold it's looking. As you can see, they're well below the zero line, kind of just at such a low level at the moment. We're back all the way back to those kind of 2011 lows. Where can we go next? Well, for us, the bigger risk reward would be to go higher, because obviously when we got down to these lows here, that was when the Swiss authorities started to intervene to limit Swiss's strength. That they actually did it via the euro, but obviously, the closer we get to, 85 level, even if we were to break the 85 level, that could definitely irritate the Swiss authorities and trigger them to do something else to try and limit Swissy strength. So there are a few things weighing on dollar Swissy. The first thing obviously has been, as I mentioned, that weakness in the US data. The second thing has been rumours actually that the Swiss authorities will start to scale back on their policy stimulus. So that's another thing that they are potentially looking at doing. So that's something that we'll be watching very, very closely. But they haven't announced anything, and we think at this level they possibly won't. But we are looking now at the better risk reward being for a kind of a rebound. Now, as you can see here, this level here, we got down to 87. Let me get the exact data for you. Sorry, everyone. There you go. You're looking at my quarterly report. You have to wait for that until the end of next week, and we'll send it to you then. But this is Again, the same chart, and as you can see, 86.99 was the low. That was the low on the 13th, as well on Friday, and we bounced higher from there. So that's when we saw on last Thursday the euro really take a bit of a beating, but we did manage to bounce off of that level. So 87 now is a very, very significant support level. So that's, that's something certainly to watch out for. We are a bit disconcerted that the upside hasn't been, or there hasn't been more of an upside. If you can see, it's not perfect. There's a bit of a doji now forming here. Let me bring up my other chart and you could maybe see it a bit closely. You can't really see it. Well, there was one here, you could argue. Can you see that there? Hopefully some of you can. That potentially could suggest just a bit of indecision as we get close to this 87 level. And indeed, we have moved higher from there. Pan, you're saying, why has oil fallen? Oil seemed to fall on a couple of things. Some supply coming back into the market. We also have, which obviously more supply can put downward pressure on the price. We also have, obviously some of the cooling of the tensions. I wouldn't necessarily say, though, that, the oil price, I would imagine, will be sensitive to what happens in the Ukraine here. So let's take a quick look at Brent on that note. Let me just bring up my chart for you guys. As you can see, oil fell very, very sharply yesterday, and it fell very, very sharply in contrast to what stocks were doing. So I think it's a risk move. Oil doesn't always move with risk, considering it had moved higher at the start of this month when the Ukraine crisis was really kicking off. We've just kind of really taken it out of the equation now because it doesn't look like there's going to be any type of sanctions that's going to threaten the oil market. Not yet, anyway. Obviously, we have to hear more from Russia and more from Putin to see if that will happen. Right now we're trading just below 106.5. 105 there is the bottom of the range. So we are looking quite weak. We did have a very sharp fall yesterday. We do think that any move in Brent back to 105 could be picked up on the dip though. And that's a significant level of support that goes all the way back to November last year. We are to get through it, and those November lows that come in around about 103 come into play. So yes, there could be further downside. But we could see oil just a lot of volatility in the oil price, I believe, until it's a bit clearer on what's going on with this crisis, with what's going on with Russia and Ukraine, and how the rest of the world feel about it, whether or not they're going to be happy to let Ukraine kind of join in with or Crimea, become part of Russia, like that referendum seemed to suggest it wanted to. Right now, it does seem like sanctions are fairly toothless. We've written about this quite a lot already. In fact, I'll send you a link to our research so that you can look at it directly on there. Oh, move up there, so that you can look at it directly. We have a lot of stuff on there. We publish about 12 pieces a day. So you can never get bored. There's always ideas being generated. And that's what we'd kind of continue to like to see. Okay, now tomorrow, and those of you based in the UK will know, it's a massive economic day today. We've had nothing pretty much in the UK all week. And then it all comes together, right? So we get Bank of England minutes, we get labour market data, we get the budget preview, and the pound is weak as we lead into it. As you can see here, we have been falling. We've basically been moving sideways. We're still in an uptrend, that's for sure, but we are approaching a key level of support there at 165.57. We're currently trading 165.95. 165.57 is the pink line on this chart. It's the 50-day moving average. If we fall below there, it could take us back to those early Feb lows. So that's the risk, that we just then trigger a deeper fallout for this pair. So that's kind of where we're watching now. Obviously, we know that the pound is very, very sensitive to economic data, particularly to labour market data, because that does mean quite a lot. Tomorrow we're expecting a bit of a mixture, really. The unemployment rate to stay at 7.2%. The jobless claims number to fall by 25,000, and also wages to rise. Now the Bank of England is expecting wages to rise. They're expected to rise to 1.3%, which isn't fantastic. It's still negative when adjusted for inflation. But any upside there could actually be greeted with a bit of a relief rally in the pound. So we could see, maybe just a bit of a move higher back up to those kind of 167.59 levels. It still looks to me like this is a bit of a double top here at that 168.20 to 30 level. We really don't seem to be able to hold on to gains. Let me bring up this chart and I will show you a bit more. As you can see here as well, we've got a bit of a bearish crossover on the MACD. So there are some technical signals to suggest that from the technical perspective, the pound looks like it's seen better days and that we could have a bit of a sharper pullback. But on the other hand, we do know that this fundamental data is going to be absolutely critical. So in some ways, you kind of almost want to wait for the fundamental data before taking a stance, and that's what we're going to be doing because it's just too hard to second guess that data at the moment. That's kind of been where we are with everything. Now I'm just going to try and let me just pull up a chart just to see what's going on with that. Let's check the euro. That seems to be affected by what's going on with that Putin speech. Also, he's not really said anything too new, and we're still trading around the lows of the day, but one would have thought if he was going to freak out the markets that we'd have really extended things on the downside. Doesn't look like we have. As you can see though, let's just take a quick look, just a bit more of a look at euro. So I did mention that. I don't think I gave you many support levels. This is a key one here, 138.44. It's the tan can line on the chart. That's as a real definite one. The other one is it's the low of the week so far, which came in at 138.34. Yeah, and that was from the 11th. So we're still some way from there. So we're still looking fairly strong in euro. And it doesn't look like Draghi's knocked us too far, of course, even though we have actually been falling today. So we'll all digest that. No doubt there'll be a lot more written about it from us today. So follow us on forex.com. That'll be a good one. Now, what about gold? Gold has been so interesting, right? Yesterday, gold sold off quite sharply on the back of that broader period of risk seeking. We backed away from those 1398 highs, just on the cusp of 1400, and we pulled back. But really, we think any pullbacks potentially back to that 1340 level could be used as the top of this recent range really as well, which comes at 1358. Then you get support at 1340. That could be used as a buying opportunity. Now, some of the reason why gold, the increase in gold has also coincided with the crisis going on in Russia. So one could say there is a link. One could say potentially. They are starting to, reflect some of the weaker. They are starting to reflect some of the weaker or some sentiment. Some changing sentiment, I suppose, to the Russian situation. So we think if the Russian situation calms down, if Putin's not as maybe volatile as some expect, then we could see just a bit of a deeper pullback in gold. But as you can see, it looks quite strong. The key support now lies at that convergence of the 50 and 200-day moving average. In fact, it looks like we could just about be on the cusp of the 50-day crossing above the 200-day. That's a bullish sign, right? When a short-term moving average crosses above a long term, it's just kind of a prolonged change in trend. That comes in at 12.95, so we're some way from that support level. We will also be watching the 50-day moving average crossing above the 200-day. The other thing I just want to show you is the cloud. Well above the top of the cloud there. And we are finding support right now on the Tankan line, which comes in at 1360. So we're going to be watching that to hold. If it doesn't, then that's what could take us maybe down to the kind of the bottom of the most recent range. 1330 was really key resistance on the way up. So we'll be watching that closely. But as I said, it's been very torturous. And I know some of you, will do find these conditions very tough to trade in. They are tough. The market doesn't seem to have, as you can see, it's not been like a straight line. It's not confident, period. That is for sure. Weak Chinese data, any thoughts on Aussie and Kiwi? We're going to get really important data next week from China as well when we get those flash PMIs. That's going to be really interesting to look at to see if the weakness persisted for yet another month. Any thoughts on the Aussie? Let's pull that up. The Aussie, as you can see, it's in that holding pattern. It rallied yesterday with stocks. It's come off again today with stocks. That's what it's doing. We haven't really, if I just pull up the, over the last 5 days, haven't really been able to extend much above 91, which is quite concerning for those people looking to see an extension in the Aussie. But we are looking, as I said, we're just moving sideways at the moment. I think really we need to get above 91.50 for us for that to really see another kind of push higher. And that's what I mean when I say that these markets are very frustrating. We had, since February really, we pushed higher, then we moved sideways. At the start of March, we made another push higher, and we just haven't been able to get above that 200-day moving average. So really, until we get above there, I think a lot of people are going to be like, there's some downside weighing on the Aussie. Obviously that Chinese data being key. There's also a lot of volatility in China now, what with the renminbi band being widened and then China falling yet again. Obviously, the trouble is for someone like Australia is that a weak renminbi essentially may cause the Australian exports to China to become less attractive because they become very expensive. So it could have a knock-on effect on Aussie growth down the line. So as you can see here, 91.49 is the upside that we're looking for, a break above there, very, very bullish. Whereas on the downside, we're being protected right now with a 100-day moving average, which comes in at 90.35, and also 89.36. And as you can see, these moving averages have really kind of capping the range, the top and the bottom of the recent range, and they're worth watching out for quite closely. Now, the Kiwi as well. Obviously, last week, big week for the Kiwi. The RBN did the first people to hike, first central bank to hike interest rates. That's been a lovely trend for this quarter. Breaking out of that 84 level was a very good move. We're now approaching 86. There is a bit of hesitation, as you can see here. We had that long shadow there. Whenever you get long shadows and it's not followed through, that can be that can suggest that there's some sellers coming in at 86. But we may give it a test. We are still looking quite strong. If we get above 86 and 86.76, that's the high from the 11th of April 2013. That comes into view. But as you can see, that could elicit some selling pressure, particularly if we have a weak risk environment, and we also have a weak kind of, Chinese and Australian environment too. The Kiwi is also benefiting from further weakness in Aussie Kiwi. As you can see here, though, we have found support at 105. The low is still that January low, which came in at 104.93. So that's still holding right now. So that's kind of critical. So I would say, Kiwi still looks quite strong. We could see further upside. They are going to be hiking interest rates, and that's a powerful thing, particularly when interest rates are so low around the world. You get the carry trade, right? And then, the prime example of the carry trade is this Kiwi yen. Kiwi yen has been a bit less of a oh, sorry, that's not it. Let me just update it. Kiwi yen has been a bit less of a reliable trade because obviously we've seen some weakness, or some strength, in the yen overall, but it is looking quite strong. It made fresh 12-month highs. We fell back to that 86.30 level, and 88.23 is actually the upside. So kind of about 130 pips from where we are now. Could potentially run into a bit of resistance, and we would expect to. Obviously, if we get into a weaker risk environment, maybe Putin says something or something happens, then that's when we could see, Kiwi yen really start to sell off. But this is also where you would expect to see Putin's comments come through. And as you can see, Kiwi yen has actually started to bounce a little bit, which suggests that risk hasn't been too turned off by what Putin has to say. I want to show you guys the FTSE as well, because yesterday, for those of you who haven't looked already but who do trade stocks, looking at the daily closes was really important, because obviously we tried to get above the 200-day moving average, but we failed. Today we kind of backed away, and this is the FTSE, by the way, here. As you can see, there have been some, we're obviously not nearly at the levels that we were at the beginning of Feb, but that 6,400 level is now coming into view. If we can't get above the 200-day moving average, which comes in at 6,578. We're currently trading 6,550. So we'll be watching it very, very closely. I wouldn't commit it myself at this stage one way or the other. We've obviously seen quite a lot of negativity priced in already. We've got a budget tomorrow, we've got labour market data, and we've got Bank of England minutes. in order of importance, I think the minutes are probably the least important. Then you get the budget, and then you get the labour market data. But the budget could have a bit of an impact. Obviously, a lot of the things that would affect the corporations, though, that's already been signposted. For example, the cut to corporate tax rates has already been signposted. And some changes to personal allowance income tax, that's already been signposted. So we doubt there's going to be anything too new. It's a very steady as she goes budget. If you check out our research page, you can see my preview on it. That was released last week, so you might have to scroll through a few of the pages. But it's certainly worth kind of looking out for. But as you can see there, yesterday's rally, even though it felt very strong while we were in it, didn't actually break any fresh ground for us. So we're still in those holding patterns. Okay, so in this environment, the best way to do it is mark out your territory and then kind of, leave orders or go and reassess once we see a bit of movement, because right now it's quite hard to trade these moves. It's better to plan for the next move if we get a breakout to one side or the other. Okay, guys, I'm over my allotted time slot, but if you've got a question, I'm happy to take one. Where would you buy? That's Miss Merck C. I probably on a break above the 200-day, actually. I think that would trigger some further upside. So a clear daily close above 6578. I think a lot of people would be interested at that level. It was just, that's a significant level of resistance now. And obviously the 200-day moving average, a lot of people look at it. And when you look at technical analysis, it's where, where's the crowd looking? So basically, if we get a break above that 200-day moving average at 6578, then we could see, other people come into the market. So that's probably what I'd be looking for. I'd be looking for a breakout, rather than a buy on dips at the moment, because I just think there's a lot of, buying on dips at the moment hasn't been a particularly great strategy for crosses, because we've actually seen, because what we've actually seen is, has been kind of reversals when we ever get to kind of key resistance levels. So you've got to be in there, have very, very tight stops, be constantly watching the market, and if in fairness, if you work, that's very difficult to do. So rather than that, have a bit of a breakout, so we can clear on a daily close above that 200-day moving average, then we could see a recovery. I think with kind of stocks generally, we've got a very indecisive rally. They're taking, even though stocks seem to be taking the Crimea standoff quite well, they bounced quite sharply yesterday. We didn't really see any big moves, any breaks kind of above big technical level. So there could be more gains to come for sure. But we don't know whether or not we've seen, there's more to the shakeout to come. So that's kind of my concern here. I think that, if anything, it seems to be, one day if the markets do one thing one day, people go short in a small position the other way. They're not allowing trends to run. So that for us is kind of quite a big thing, that we're going to be watching closely. All right, guys, I'm going to leave it there. But thank you all so much for joining. As always, it was great to have you here. And if you've got any other questions or anything else, please join us next week. And please do follow our research. Follow us also on Twitter on ForexCom. We answer a lot of stuff there. So anyway, hope to see you, or hope that you can join next time. Thanks, everyone.